One word has quietly shaped the course of human civilization: taxes. It's a term that evokes groans and eye rolls today, but its impact is far more profound than a mere financial burden. From the dawn of recorded history to the modern world, taxes have been the unseen architect of empires, societies, and even the simplest aspects of our lives. From the grand stages of history to the intimate corners of our daily existence, taxes have played a starring role. The rise and fall of nations, the spark of revolutions, and the evolution of everything from fashion to food can be traced back to this often maligned concept. It's a fascinating story, one that stretches back thousands of years, influencing everything from the ancient Egyptians to you and me. Believe it or not, the story of taxes is as old as civilization itself. Long before shiny coins jingled in pockets, the pharaohs of ancient Egypt were already demanding their cut. A 20% tax on every single grain of wheat, barley, and everything else that grew from the fertile Nile. No wonder they built those giant pyramids. They had a pretty sweet tax fund. Fast forward a bit, and we meet Julius Caesar, the man who brought us the idea of paying taxes on stuff we buy, and his adopted son, Augustus Caesar, decided to get even more creative by inventing income tax. So, not only were people paying for their purchases, but they also had to hand over a chunk of their hard-earned cash. It's clear that taxes have been around forever, quietly shaping history as we know it. The Magna Carta, that famous old rule book, is often remembered for fair play and stopping people from using those sneaky fishing traps. But it also did something pretty revolutionary. It said the king couldn't just make up new taxes whenever he felt like it. People had a say. Speaking of people having a say, let's talk about the American Revolution. We all know taxes were the biggie, right? But it wasn't just about paying too much. It was about fairness. The colonists were like, hey, we're not even part of the club, but you want us to pay? That's not right. This whole no taxation without representation thing was a big deal. Taxes aren't just about history books, though. They shape our world today. They pay for roads, schools, and firefighters. They decide who gets elected and where we choose to live. And whether taxes are a good or bad thing often comes down to how they're set up. Simple, clear, and fair tax rules are the best, while confusing and unfair ones can cause big problems. So, while taxes might not be the most exciting topic, they've been around forever and will continue to shape our lives. It's a wild ride, from ancient Egypt to today, and it never slows down. And if it never slows down, not until we're dead, why not take the time to understand them better? Let's start with different types of taxes. This is the tax that most people know and love, or love to hate. It's essentially a slice of your paycheck that goes to the government. While the basic concept is simple, the intricacies can be mind-boggling. Income tax, as we know it, has its roots in the early 20th century. Governments needed a reliable source of income to fund growing public services like education and infrastructure. And income tax was seen as a fair way to distribute the burden. How it works. Income taxes are typically progressive, meaning the more you earn, the higher tax rate you pay. This is based on tax brackets. For example, if you earn $50,000 a year and the tax bracket for that income is 20%, you'll pay $10,000 in federal income tax. But that doesn't mean you pay 20% on your entire income. It only applies to the portion of your income that falls within that specific bracket. Income tax is the government's bread and butter. It funds a wide range of public services, including education, healthcare, infrastructure, roads, bridges, etc., social programs, welfare, unemployment benefits, defense, even R&D. You might know about them too. Every time you swipe that credit card, you're probably paying more than you think. Sales tax is that sneaky little fee tacked onto the price of goods and services. It varies from place to place, but it all adds up. Imagine buying a new pair of sneakers for $100 with a 9% sales tax. You're actually paying $109. It's like getting an unexpected surprise at the checkout. But where does this extra cash go? And how did it start? Sales tax is a relatively modern invention. It gained popularity in the United States during the Great Depression as a way for states to generate revenue. The idea quickly spread worldwide as governments realized its potential as a steady income stream. How it works. Sales tax is typically a percentage added to the purchase price of most goods and services. The rate varies by state, county, and even city. Some items, like groceries and clothing, might be exempt in certain places. Sales tax revenue is a significant source of funding for state and local governments. It helps pay for many sectors, just like income tax. Now, if you're lucky enough to own a home or land, congratulations, but get ready for property tax. This is a fee based on the value of your property, and it's paid directly to your local government. It helps fund schools, roads, and other public services. Let's say your home is valued at $300,000 and your property tax rate is 1.2%. That means you'll owe $3,600 a year. It's like paying rent to yourself, but without the fun perks of living there. But where does this money go, and how did property tax come to be? Property taxes are one of the oldest forms of taxation. They were used in ancient civilizations to fund public works and services. Today, they remain a cornerstone of local government revenue. How it works. Property taxes are calculated by multiplying the assessed value of your property by the tax rate set by your local government. The assessed value is an estimate of your property's market value. Property taxes are crucial for funding local services, including public education, police and fire departments, libraries, parks and recreation, etc. One thing to remember about property taxes is that their laws vary by location, so it's essential to understand the specific rules in your area. This one is boring and interesting at the same time. Capital gains tax is levied on the profit you make when you sell an asset that has increased in value. To make it easier, if you sold a stock for $1,000 that you bought for $500, your profit is $500. Depending on your tax bracket and how long you held the stock, you might owe capital gains tax on that $500. Capital gains taxes have been around for a long time. However, their structure and rates have changed significantly over the years. Governments have used them as a way to generate revenue and to influence investment behavior. How it works. Capital gains tax is generally calculated as the difference between the selling price and the purchase price of an asset. But the tax rate depends on several factors, like the type of asset, stocks, real estate, collectibles, etc., and how long you held the asset, short-term or long-term, or your overall income tax bracket. Capital gains taxes contribute to general government revenue, which is used to fund various public services and programs. Estate tax is imposed on the value of your assets when you pass away. It's a way for the government to get a piece of the pie after you're gone. Imagine leaving behind a $5 million estate. Depending on the estate tax laws in your area, your heirs could owe hundreds of thousands of dollars in taxes. It's like a final goodbye to a big chunk of your hard-earned money. But why does this tax exist, and how can you potentially minimize it? Estate taxes have been around for centuries, with variations appearing in ancient Rome and Greece. The modern estate tax in the United States was introduced in the early 20th century. How it works. Estate tax is generally calculated based on the total value of your assets at the time of your death, minus debts and certain deductions. The tax rate varies depending on the size of the estate, Estate taxes contribute to general government revenue, which is used to fund various public services and programs. Every paycheck, you see a mysterious deduction labeled FICA. This stands for Federal Insurance Contributions Act. It's a combination of Social Security and Medicare taxes. Both you and your employer split the cost. If you earn $50,000 a year, you'll pay about $3,800 in FICA taxes. It might seem like a small amount, but it adds up over time. Let's break down this often overlooked tax. Social Security was established in the 1930s as a safety net for older Americans. Medicare, a health insurance program for the elderly and disabled, was added later. Both programs are funded primarily through payroll taxes. How it works. FICA taxes are a percentage of your earnings deducted from your paycheck. Your employer matches your contribution. The Social Security tax rate is 6.2% on earnings up to a certain limit. This limit changes yearly, while the Medicare tax rate is 1.45% on all earnings. There's an additional 0.9% Medicare tax on higher income earners. FICA taxes are dedicated to funding Social Security and Medicare programs. Social Security provides retirement benefits, disability income, and survivor benefits. Medicare helps cover healthcare costs for people age 65 and older, as well as younger individuals with disabilities. Self-employed individuals pay a higher FICA tax rate to account for both the employee and employer portions. Taxes might feel like a pain, but understanding them is key to managing your money. From the ancient Egyptians to today, taxes have shaped our world. They pay for things we all use, like roads, schools, and hospitals. While taxes can be confusing, knowing about different kinds can help you save money. By understanding how much you owe and why, you can make better choices about your finances.